$100 a week into DVY today will make you achieve a happy retirement. You're working hard, saving when you can, and dreaming of a future where money isn't a constant worry. But what if I told you that just $100 a week, less than what most people spend on takeout or subscriptions, could turn into a monthly income of over $13,000 in retirement? Sounds impossible, right? That's the power of compounding and dividend investing at work. In this video, we're going to show you exactly how a simple, steady investment in DVY can snowball over time, creating a massive stream of passive income. No complicated stock picking, no day trading, just reliable growing dividends that work for you. If you're ready to see how $100 a week can transform your financial future, let's dive in. What is DVY? Alright, there's a lot to take on with DVY. We will begin by simplifying the concept. Imagine you have a piggy bank that not only holds your money, but also grows it over time, and even pays you for using it. That's basically what DVY does. DVY, or the iShares Select Dividend ETF, is like a basket filled with some of the most reliable, high dividend-paying companies in the US. These are companies that don't just make profits, they share those profits with their investors through dividends. As you know, this is a fancy word for cash payments given to you just for holding your stock. Think of DVY as a team of all-star businesses, like utility companies, banks, and energy firms, that have a track record of consistently paying and increasing dividends over time. So instead of picking individual stocks and hoping they do well, DVY gives you a diversified group of winners in one simple package. And here's the best part. The dividends you earn can be reinvested to buy more shares, which leads to even more dividends, and over time, your money starts snowballing into a powerful income machine. Holdings in DVY. DVY isn't just another ETF. It's a powerhouse of dividend-paying giants that help investors build steady income. Imagine assembling a dream team of businesses that have been paying out cash to their investors year after year, no matter what's happening in the market. That's exactly what DVY does, and its top holdings are a mix of industries that keep America running. At the top of the list is Altria Group, MO, the tobacco giant that has been a dividend king for decades. Love it or hate it, Altria knows how to generate cash, and it generously shares that wealth with investors. Right behind it is AT&T, a telecommunications behemoth that has been connecting people for over a century. AT&T might not be the fastest growing tech company, but it keeps paying out dividends like clockwork. Then there's Philip Morris International, PM, another tobacco heavyweight. While smoking rates may be declining, Philip Morris has pivoted into reduced-risk products, keeping its cash flow strong and its dividends steady. International Paper, IP, is next, proving that even something as simple as packaging can be a lucrative business when done at scale. With e-commerce booming, cardboard and paper products aren't going anywhere. Think about some of the biggest names in finance: Citizens Financial Group, Truist Financial. These aren't just banks. They're dividend machines, consistently paying and growing their payouts year after year. Then you've got powerhouse energy and utility companies like Dominion Energy and ONEOK. These are businesses that keep the world running, whether the market is up or down. This mix of industries, telecom, finance, energy, and materials, gives DVY its unique edge. That said, let's go a little more in-depth on its sector allocation. DVY isn't just about picking the best dividend payers. It's about balance, resilience, and long-term income growth. If you peek under the hood, you'll see that it spreads its investments across industries that keep the economy running, even in tough times. Utilities take the top spot, making up over a quarter of the fund. Think about it. No matter what's happening in the stock market, people still need electricity, water, and gas. That means steady cash flow, which translates to reliable dividends. Right behind utilities, financial services holds a significant portion of the fund with 21.10%. Banks, insurance companies, and financial institutions thrive in different market conditions, and their dividends provide a crucial income stream. Then you've got consumer defensive stocks, companies that sell essential goods like food, beverages, and household products. These are businesses that don't rely on economic booms to make money, because people will always need them. Now, here's where things get even more interesting. It's not just financials and utilities pulling the weight. Energy, consumer cyclical, and communication services all have a solid presence in DVY too. Think about it. Energy companies keep the lights on. Consumer cyclical stocks thrive as spending habits shift. And communication services? Well, let's be real. We're never going back to a world without constant connectivity. These industries aren't going anywhere. And with DVY, you get a piece of their profits in the form of dividends. What's interesting is what DVY doesn't have: real estate. While real estate investment trusts, REITs, are known for paying dividends, DVY skips them entirely. Instead, it sticks with companies that have a long history of stable, growing payouts. And that's the magic of DVY, letting top-tier companies do the heavy lifting while you watch your passive income grow. But just how effective is its strategy? To answer that, we have to turn to its historical performance of DVY. Let's take a step back and imagine you started investing in DVY all the way back in 2003. Over the years, this fund has delivered an average annual return of 8.43%, a solid performance that has somehow kept up with the S&P 500, which has averaged around 10% per year. And just look at the past year, 16.19% total return. That's right in line with the broader market, proving that DVY isn't just about collecting dividends, it's about growth and resilience. While the S&P 500's dividend yield hovers around 1.5%, DVY's yield sits at a much higher 3.58%, meaning you're getting more income along the way. It's a trade-off: less explosive growth, but a much stronger cash flow that can be reinvested or used as passive income. As of February 11, 2025, DVY boasts net assets totaling over $20 billion, underscoring its prominence and the trust investors place in its strategy. The fund's expense ratio stands at 0.38%, offering a cost-effective way to gain exposure to a diversified portfolio of dividend-paying stocks. Right now, DVY is sitting at around $134.45 per share, and over the past year, it's traded between $113 and $143. That tells us something important. Investors believe in this ETF. Even when the market has its ups and downs, DVY stays strong. Now let's talk about what makes DVY such an exciting investment. We mean the numbers that truly matter. Financial metrics. First, there's the dividend yield, sitting at a solid 3.58%. That means for every $100 you invest, you're getting back $3.58 in passive income every year just for holding the fund. It's like having an investment that not only grows, but also pays you just for sticking around. But here's where it gets even better: dividend growth. DVY doesn't just hand out the same amount year after year. Over time, its dividend payouts have been growing at an average rate of 7.13% per year. That's the power of compounding in action. Imagine getting a raise at your job every single year without having to do anything extra. Just sit back and watch your income increase. And then there's the annual return on share price, which has averaged an impressive 9.20%. That means if you reinvest those growing dividends, your money isn't just sitting still, it's compounding, accelerating, and building wealth over time. Combine that with the dividend yield, and you're looking at a total return that can rival some of the best long-term investments out there. So let's put these numbers to the test. Let's talk about what happens when you commit to investing $100 per week or $5,200 per year into DVY. Return projection. At this point, you might be skeptical. Can just $100 a week really make a difference? Lucky for you, the numbers do speak for themselves. After 1 year, you've contributed $5,200, and your portfolio is worth about the same. But the real growth is just the beginning. By year 5, your total investment of $26,000 has grown to around $33,800, and your dividends are already kicking in at about $1,020 per year. This is a small but steady cash flow that's only going to increase. Fast forward to 20 years and things start getting serious. Your total contributions reach over $104,000. But with compounding and dividend reinvestment, your portfolio is now sitting at an impressive $487,000. More importantly, you're now earning $25,400 per year in dividends, or $2,000 per month, enough to cover rent, a mortgage, or even fund early retirement. But here's where the real magic kicks in. 30 years down the road, that $100 a week commitment, it's turned into a massive $2.3 million portfolio. And guess what? You only contributed $156,000 of that. The rest came from your money working for you. But the best part, the passive income this portfolio now throws off, $157,000 per year, or $13,000 every single month. That's more than what most people make at a full-time job. At this point, you're not worrying about bills or clocking in at work. Your investments are paying you, and the income just keeps growing. This really is how wealth is built. It's not about getting rich overnight, but about making smart, disciplined choices that pay off massively over time. Just $100 a week invested in DVY could set you up for a future where you're collecting over $13,000 per month in passive income. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.